welcome everyone to this episode of the Minds and Money 5 at 5. We obviously started this on the 2nd of April, and since then we have been hosting this on a fortnightly basis here in the APAC region. The series is supported by the Melbourne Mining Club, so we do thank them for their continuous support of the event. And today's episode, we're partnering with Gresham Resources, James Morrison and Simon Klimt, both here on the call today. As I said, you know, it's great to see the returning guests on a weekly, fortnightly basis. It's nice to see familiar faces, and I can't wait to see you guys in real life at our live events or otherwise. And obviously welcoming anyone who is new to the series as well. Minds and Money and IMARC are also now launching our first APAC event, which is happening on the 23rd to the 25th of June. That particular conference is a collaboration of our two conferences, Energy Minds and Money, as well as Minds and Money Asia. So we've already got some great confirmed speakers for that, including over 20 investors, as well as Jake Klein from Evolution Mining, and also Cameron Horace from Sojitz Coal as two keynote speakers for that particular event. Another thing that we do have, I will announce in a second, but before that, I will let everyone know, especially anyone who's new to this conversation, is that everyone is on mute at the moment. And if you do have a question during the conversation, there is a way to put up your hand virtually or otherwise via screen, and we'll try to unmute you. And the other way is obviously through the chat room. So if you would like to ask a question to any of our panelists, please do so via either of those ways, and we'll reach out to you. On the back of the 5 at 5 series, we're actually really excited to also launch, on top of our APAC online event, the IMARC Mets Arena Live. So basically, off the back of 5 at 5, the Victorian Government, specifically the Minister for Resources, Jacqueline Symes, has now decided to partner with us and our founding partners on an exciting Met-specific conversation that will be happening. Lucy, I believe that you've got a short video that you might be able to play for us just in regards to that.
Yep.
Hi, I'm Jacqueline Symes, the Victorian Minister for Resources, and I'm very pleased that the Victorian Government is partnering with IMARC to deliver a fantastic new initiative called IMARC Mets Arena Live. IMARC Mets Arena Live will connect miners, engineering companies and contractors with our amazing Mets companies to solve industry problems and explore new ways of doing things. Live events will be held every fortnight through till October, and the format will be a live panel where participants can ask questions of our guest hosts in real time. Of course, in these unprecedented times, where doing business in person may not be possible, it's more important than ever that the global mining and Mets industry stay connected. I'm delighted that IMARC is helping to ensure the mining industry can still come together to understand what's needed, to discuss what's possible, and create new opportunities. I'm glad the Victorian Government is playing its part. I really hope you can join an IMARC Mets Arena Live event soon. Thank you.
A small little plug there from the Minister in regards to the Mets event. But without further ado, I do want to pass on to James Morrison of Gresham Resources to kick off today's 5 at 5 episode, which is around the topic, very timely as well, on royalty, streaming and alternative financing. Over to you, James.
Thank you. Thank you very much. I'd like to thank everyone for attending today, and thank you also to Minds and Money for inviting Gresham to host this 5 at 5 event. We have 3 very accomplished mining professionals to speak with us today about their projects. Simon Finnis, who's the CEO and Managing Director of Metro Mining, David Reeves, who's the Managing Director of Calidus Resources, and Mark Bennett, who is the Executive Chairman of S2 Resources. To join us in our panel discussion on alternative financing, we have Sean Russo, who's the Principal and Managing Director of Noah's Rule, and my business partner, Simon Klimt, from Gresham. Before we commence the panel discussion, I'd like to give you a quick intro to the Gresham Resources Royalties Fund. After careers in resource banking and private equity and our precursor royalty business, Royalty Stream Investments, we teamed up with Gresham in 2019 to launch what we call the GRIF. The GRIF has a fund size of 150 million with a focus on investing in royalties and related products over mining and energy projects. We had our first close in August and acquired a royalty over a gas project in Queensland for around $70 million shortly afterwards. All the money for the fund was raised in Australia, mostly from high net worth individuals, but also including Regal Funds Management as the primary institutional investor. A few words about Gresham for those of you who may not know the firm. Gresham is one of Australia's oldest independent investment banks, having been founded in 1985. It's 50% owned by Wesfarmers and 50% by the staff. Its focus is on corporate advisory services, including M&A and debt advisory. It also has around 2 billion assets under management, mostly in property, and has recently launched a private equity investment vehicle and the royalties fund. We'll now kick off the panel discussion with Sean Russo on alternative financing, and straight after that I'll be asking distinguished guests to speak about their project. I'd like to encourage you to ask questions on any aspects of the discussion by raising your hand as described by Shireen, or going to the chat room. So Simon Klimp will also join me for the panel discussion. Now, although he probably needs no introduction to this audience, Sean, could you please give us a brief introduction on the work that Noah's Rule does with the mining industry? Over to you, Sean.
Thanks, James, and thanks to Mines and Money. Noah's Rule's in its 15th year. Myself and Dave Rowe, who's the principal, the joint managing director, both 35-year sort of industry veterans. We met working at Rothschild, where we were involved in project finance and hedging on the bank side. 15 years ago, we decided to sort of use our skills for good and not for evil, if you like, and work directly for the mining companies to help them figure out how to finance themselves better, manage their revenue lines, look at hedging fuel, hedging their metals, etc. So we have about 20-25 active producer clients that retain us to assist them. Many of those we've been with since they were explorers. In fact, many of them were in a similar position to Calidus is today, pre-production, looking at finance, and we've worked with them all the way through, some of them for over a decade. Particularly at the moment, focusing on project finance, James, as you know, looking at helping companies raise finance, and they're certainly at this stage spoiled for choice. There's never been more different sources of funds for mining companies than there is right now in my career.
And so when you're advising company when you advise companies on raising finance, when do you get involved? How do you evaluate the various alternatives that are presented to your clients? And perhaps you've got some experiences you want to share with the audience.
Sure. Look, I mean, keeping it very brief, I'd say there's two key themes that we find come up over and over again. Is most people start talking to lenders too early and seek independent advice too late. So they're sort of doing it themselves. They're being pulled in every direction by all the people that would like to have a piece of them or to do something. And I think, in my career, or certainly in the last 15 years as sort of a debt advisor, I can sort of remember more companies that went too early, said we're going to raise debt, got the equity market very excited, and then found it was a little bit premature. The equity market lost interest, they lost momentum, and they found it very difficult to recover. So I think the first element is make sure your lender ready before you really start engaging with lenders or providers of capital. By all means, accept their invitations to the rugby or the ballet or all the things that they're throwing at you long before then. But you've got to really be very careful when you switch around that conversation, say, right, let's talk turkey. So that's the one thing, James. The other thing I would say, and I've said this before in similar forums, is don't rule anything out. So we have people who come to us and say, I want to borrow money, this is what I need to do, this is how much money I need, but I don't want to hedge, or I don't want to deal with bank XYZ, or I don't want to do a royalty, or I don't want to do a stream, or I don't want to do this. So they sort of clear in their mind what they don't want to do. And when you ask them why they don't want to do it, well, because they were in a company that did that before and it didn't work, but it may not be right. And what we try and say to the clients is that you've got a triangle that you're dealing with. You've got lender appetites or interest. You've got your share price, which is you're going to need to raise some equity. And you've got the commodity price that's going to underwrite the revenues of your project. And if you think about that and you're sitting in a triangle and you're somewhere in between those 3 points, those 3 points can change dramatically. lender appetites have changed dramatically in the last couple of months if they're a bank. The world has changed for banks in a way it probably hasn't changed for private equity lenders. So that's going to change that part of the thing. Your share price can sometimes be going the opposite direction to the commodity price. Generally, when they're going the opposite direction, it's not favourable to you. So, you know, that's another thing. So we might start on a project saying we're going to borrow money from the bank because that's the cheapest form of money. Company's happy to accept some hedging. But we say, don't rule out these other guys, because if we get 2/3 of the way through this process and those dynamics change, you may need to change your mind. So I think that those are the two key ones. And
so, Sean, where does royalties come into that? I mean, do we factor in the discussion? I mean, I saw that SolGold did a royalty this week with Franco-Nevada, which seemed like a good deal for their shareholders.
Yeah, look, it does. I mean, there's the criticism, particularly from Sandeep Biswas, is focused on the high interest rate they're paying in the very short term, but ignores the value that they've raised from that royalty that they're really seeking relative to, you know, giving away a percentage of the project versus percentage of the register. It looks like a great deal. I mean, I'm a shareholder. I'm a shareholder there in SolGold, and yeah, I think it's a good deal for shareholders. It's an interesting exercise. It is an interesting point though, because certainly royalties in Australia, I find it's one of those things a lot of people say, well, we don't want to do that. Whereas overseas, they're far more, people have a much more open mind when we've been dealing with companies in other parts of the world. So I think SolGold's a very good example. It'll be interesting to see how the local market embraces it, because quite frankly, if you can sell 2% of your project and get a lot more money than what you would get for issuing 2% of your equity, it's got to be a good deal, because part of the issue with giving away paper is it's life of mine and life of every other mine you might find within your properties that no one even knows about yet. I think people underestimate that. You know, people say, oh, I don't want to do a royalty or a stream because it's life of mine. But issuing equity is life of mine as well.
Well, yeah, I think they seem to raise, from what I read of their release, they seem to raise a lot of the points that we tend to make to our clients about why you do a royalty. You know, we are, and they've seen it as permanent capital. You know, it's not capital that's going to turn around and sell the share price straight afterwards. They also identified that, you know, the value gap, as you pointed out. I mean, 2% basically versus they probably have to dilute 15% of their shareholding. So I think they seem to have identified this week a lot of the alignment that we have as a royalty investor with mining companies, because we are there for the long term and try and can represent that value up front, whereas sometimes equity markets don't do the same.
Yeah, I think the other aspect that you have to consider with that is, we all know, those of us that hang around in the junior sector particularly, the enormous gap at the moment between the share prices of producers and the share prices of will be producers given time. I mean, that gap is still really there, and you know, people like David would be very aware of that, and Simon's had those experiences in the past. So I think that's part of it. But also, I was just looking the other day at the Franco-Nevada share price. Franco-Nevada share price is 3 times what it was at the 2011 gold price highs. So while the general index is much lower, now the critics of royalty and streaming will say, oh, well, look, there's where all the value transfer's gone. So it's obvious, you know, from that perspective, you shouldn't do it. But that's not the way to look at it. If you look at the performance of companies that have taken that finance and kept their registers tight. I mean, I think any really good projects where you see shareholders do very well out of them, sometimes you get very lucky with the drill bit in enormous ways, as Mr. Bennett has in the past. But other times it's about just those shares you didn't issue early in the company's life when the market wasn't giving you value that carry through. And I mean, just in this market, and people weren't really aware of Atlantic Goldfields in Nova Scotia until St Barbara bought them recently. But that company, that was an 11-bagger for shareholders from the time they started project finance to the time St Barbara took the company over. They were roundly criticised in North America for hedging, but they hedged to maximise the debt they could get from Macquarie Bank in that case, to minimise the dilution at 20 cents a share. And really, at the end of the day, when you get to the successful end of any project financing and you look back, you have to compare what you've given up with the dilution you avoided, whether it's debt and hedging or streaming. And I think Nick Mather and the team certainly have avoided substantial dilution relatively. So that royalty deal on face, to me, looks very attractive to them.
Yeah, and if we could even point to, I guess, one slightly closer to home that Simon Finnis can also talk about. Because even at the development stage, we gave some royalty finance in our precursor company to a small company called Gulf Alumina, which Simon at Metro ultimately bought 3 years later at a substantially higher valuation than they would have raised equity if they'd done it instead of the royalty. And I don't want to put words in Simon's mouth, but I would suggest that that it didn't really reduce the value he ultimately paid for that company.
Yeah, look, wasn't even a consideration in the end for us. For us, it was all about doubling resource reserve. So from our perspective, we paid $50 million for $2 billion worth of bauxite, and the royalty was almost just sitting there. Just wasn't considered.
I think there's a couple of the guys from Lion I see on the screen as well. And if you think with Nusantara, one of their associated portfolio companies selling a share of the project versus raising equity at the public company level, looks to be a very good deal in recent times. And Galena with the Abra Base Metals project in Western Australia as well. I mean, if you look at what they sold, the share of the project there to the Japanese, instead of actually equity, it made sense. So again, it comes back to that triangle. You've got to look at the value of the metal in the ground. You've got to look at the value of the shares currently on issue. And if there's some people that have a much stronger appetite for the metal in the ground. And I think, as you guys said, you raised all your money from high net worth individuals. At the moment, there's one of the huge themes that we're seeing in the market is these ratios that are way out of whack, where, commodities versus the S&P, all-time lows, lower than it was in the 70s. In fact, you have to go back to the 1950s to find hard assets such as commodities as undervalued relative to financial assets as they are now, even after this recent share market. And a lot of high net worth individuals are, looking at agricultural land, and they're looking at hard commodities. And royalty type funds like yours is a great way to take a long-term view as an inflation hedge, which I think, most wealthy people right now are most concerned about, the potential for inflation.
Well, we certainly brought capital into the market that wasn't coming into the resources sector previously. So we think we're bringing additional capital into the market. We don't think we're replacing investors.
Oh, look, I think there's plenty of room for everyone. And as we've seen with the other funds that have been active in the market for a while, the PE funds have raised a lot of money from the US pension funds. They've been very active and take a very different view. And, I think certainly like West African, who are now, the newest African producer, they took money, those sort of alternative funds, eschewed the banks, and that's been a tremendous success for them, as it was for Toro, one of our clients who recently got taken over by Resolute. So, yeah, I mean, there's lots of examples, lots of different ways. At different times in the cycle, different lenders are appropriate and for different metals. So, yeah, I mean, the more different angles that you guys can come from our client's perspective, the better. Because as I say, we're going to be telling them to keep a very open mind and be flexible, because these commodity prices could move, quite substantially in the next couple of years. And we're thinking about that.
Okay, well, thank you very much, Sean. So how are we going on timing there, Shireen?
Yeah, look, I mean, is there anything else that the panel would like to discuss? James, Simon? Or shall we kick off onto our first project?
I think we kick off onto the next project, unless there's anything else, unless there's any questions that have already come in from the audience.
Yeah, we do. We do have some questions from the audience, but we might go to the projects and then come back to these questions, because I think they are. It's going to make it much more holistic in terms of everyone's thought on the thing. So, shall we go for the first project? I believe it is anyway. Yep. Simon Finnis from Metro Mining.
Yep. Thanks, Simon.
Good day, everybody. Lucy, if you could cue that first slide, that'd be great. It's up. Good. Look, Metro has been around now for a couple of years as an operating company. We're now into our third operating year. We're probably a little bit different to most mines in that we turn off for the wet season every year. That's purely because of where we are. We're about 100 k's from the northern tip of Australia. We mine bauxite, a simple project, and we ship it straight to China. So we're earning revenue. It's a long life mine, another 17 or 18 years to go. We're generating cash. We're in a strongly growing market. If people want to have a look at some of the metrics around the bauxite market, have a look at some of my previous presentations. They're all still valid. As I said, very simple project. We built it for about $35 million. We're about to inject about another 50 million to take it to 6 million tonnes a year. And as I said, we're so close to China that we have got an enduring jurisdiction and competitive advantage over all the other suppliers. Slide 2, please. This slide is just a snapshot of the project itself. I won't dwell on this one. It is a very straightforward project, 15 to 20 k's north-south, 10 to 15 k's east-west. As you can see, 140 million tonnes of resource or thereabout, about 109 million tonnes of reserve. Bearing in mind that was the middle of last year, so we have depleted them somewhat. So we're a direct shipping bauxite project in far north Queensland. Slide 3, please. This is just a bit on, you can probably just flick right through here, a bit of what we've done over the last couple of years. So first production, April 2018. The transaction that Simon referred to occurred late 16, early 17 when we acquired Gulf Alumina. We financed this project in the back half of 2017, built it in in the front half of 2000, built it in the back half of 17, then we're in production. Did 2 million tonnes in year 1, 3.5 million tonnes in year 2, and we're hoping to do 4 million tonnes this year before we expand to a 6 million tonne project after that. Next slide, please. And this last slide is just a bit on the important stuff for shareholders, in particular, the cash. So you can see in 2019, we were just a tick under $200 million in revenue. Site EBITDA about a $45 million. So the project itself is operating extremely well. Obviously, we have a little bit of debt and we raised a bunch of equity. We're suffering share price wise like everybody else. COVID disaster, but the project itself is going very well. We started again in last month. We had a record April, and May is looking particularly good as well. So at that point, I'll just take questions. Thank you.
Thanks, Simon. That's great. While you see if there's any questions from the audience, I've got one for you, Simon. You've obviously had a cracking start to the 2020 mining campaign at Bauxite Hills. Can you talk about the challenges the virus is presenting at the mine site and how you're managing those risks?
Yeah, sure. Look, I think what we're doing is very similar to what a lot of mining companies are doing. We're practicing very strong social distancing stuff on site. So instead of the dining table holding 4 or 6 people, it holds 2 people. So we limit the number of people that can eat together. We actually roster our dinners and meals now so that the same people eat at the same times. We stagger our shifts so that we have a shift starting at 6, 7, 8, 9. They all work 12 hours. So we do that so that we minimise people in the same transportation. And that the idea of that, of course, is if someone in that transportation comes down with COVID or with symptoms thereof, we stand everybody down. So instead of losing a whole shift, you might lose 3 or 4 people. And the biggest challenge for us really has been, the flights to and from site. So there's a cost to that, of course, because trying to social distance people on an aeroplane is not very easy. So you do manage with a bit of PPE, but everything so far, everyone's going well. We've had 2 cases of isolation, both negative, but you treat them the same. So they were both evacuated and both went to hospital in Cairns and which were negative. But we've had no disruption at all. Everyone's taking it very seriously. We've actually stopped flights into our remote Aboriginal communities. We have a large population that come out of the Indigenous community. We stopped flights to those just because of those vulnerable people within those communities. We didn't think the risk was worth taking. Luckily, that was very well received by those communities, and as soon as we can open them back up, we will.
That's very interesting. Thank you for that. And the NAIF facility, it looks like very satisfactory financing outcome for the company. I'm interested in your view. If you can give the audience a view on that, and also if you think there's anything else that the state or federal governments perhaps should be doing. to support mine?
Look, we're very happy with NAIF. Clearly, it's a difficult thing to access. The administrative burden to actually get the money is significant, even though the people that work for NAIF are all ex-investment bankers. It is government money, so you can imagine the strings they tie to that. However, they've been extremely supportive. The way it's administered through the state, again, adds another layer of bureaucracy you've got to get through, but it really is procedural for the most part. So it just takes time and patience. Luckily, I was not involved, mostly because I don't have any patience. But the process is done, the money is ready to go, the legal docs are even agreed now, so now we're just waiting for the drawdown decision. And clearly, where we are right now in the world, our board is not in a place where we can approve that expansion. So we're looking to do that in the next month or two, and then we'll draw down the money. Everything else is ready to go. But we're very, very happy with the debt. Very, very competitive. Okay,
and just finally, I guess I wonder how you're seeing the financing landscape more generally from your perspective. Are investors and financing partners showing interest once again in the middle of COVID? Have you got a view on that you can share?
Look, I guess we're lucky to a certain extent that obviously we're in revenue, so we're not considering that. However, we get a lot of interest from all sorts of different funds. We understand there is money around. I think it's fair to say that if you are in expansion mode, are going to be doing something positive with the money, that's much more than just a balance sheet, much more positive. But certainly there is plenty of money out there.
Okay. Any other questions, Shireen?
No, there doesn't look to be any questions. But interestingly, obviously, you made the comment about the governments and their role. Our next APAC episode, which is on the 28th of May, is actually run by AMEC and will involve both the Queensland government and the New South Wales government talking about some of the things that they're looking to do to help explorers and miners in those particular states. So quite interesting that that question did come up.
Okay, thank you very much. Well, perhaps we move on to Calidus now. If I could ask David Reeves to introduce his company and please, David, if you could take over. Thank you.
Sure, thanks, James. So Calidus Resources, we're a gold development company. Our main project is called the Warrawina Gold Project. It's in the Pilbara, just outside Marble Bar. It's got 1.25 million ounces of resource. That resource is outcropping at surface. So this will be a conventional large open pit mine with just a conventional gold plant, very, very conventional West Australian gold mine all up. We did a pre-feas back in June last year. These are the metrics of that pre-feas. Around 100 million to build in Australian dollars, around that 100,000 ounce per annum mark, 11.50 an ounce all in sustaining cost. We've got a range of sensitivities there. Unfortunately, we've run out of gold prices there. We need to keep going to the right. It's obviously been a fantastic time for gold. And that's something we'll talk about afterwards on the development path and tie back into what Sean was saying, because the disconnect between the cash that we can throw out here, well over 100 million EBITDA per annum versus our market cap of 60 million means that we are certainly looking at alternative finances, with a great deal of interest, because it all comes back to an NPV per share for our shareholders when we look at financing and making sure that finance is an acceptable risk. We can just do the next slide, thanks. Assuming that's popping up on people's screens. What we've got coming up this year, it really is all about getting this project into development next year. We're really constrained by permitting, in particular the EPA. We've referred ourselves to the Environmental Protection Agency of Western Australia for some bats and an old working nearby. You can track us live on their website. We're about 80% of the way through the process, so we're looking for some good news shortly on that, and that releases the brakes on all the other permitting of the safety, explosives, etc. So we feel that's well in hand for the end of the year. We're putting out a resource upgrade later this quarter, definitive fees late next quarter, and in parallel with that, we'll be undertaking the project financing. We're looking at doing early works late this year. That's putting in the village, the water bores, the communication, so that when we've got the permits and financing all tied up early next year, we can press a button and start building a new gold mine in Western Australia, which we're very excited about. Beyond that, obviously we will be focused mainly on that, but we've got a lot of ground out there we really haven't touched. We've just finished our aeromag and radiometric survey. We're waiting on the results of that now. And we're putting in a few holes, at depth. The current resource is really only defined to 200, just over 200 metres below surface. So we're going to put a couple of holes down 600-700 metres below surface just to prove the continuity of Klondike and show that there will be life there for a long time to come. And then we'll get into further de-risking. I think that's a common mantra of the development team, seeing we've built mines before. It's all about minimising risk. So we'll be doing more drilling. We're looking at how we stage our operations to make sure we've just got one focus, and also obviously on the financing side, we come back to what we see as an acceptable risk and how that ties in. That is a very brief summary. There's plenty of information on the website, or you can always email me, but open to questions.
Thank you very much for that, David. I'm interested, could you just give us a snapshot of how you brought this project together, a bit of the history perhaps?
Yeah, sure. So we were introduced to a couple of tenements up there that had a historic resource on them, but they were fragmented ownership. And by doing a series of 7 transactions, we've managed to pull the area together. Gold was first mined here in the 1890s. So it's a known gold field. It was actually in production before Kalgoorlie, but then sort of sat idle. It's a little more remote, a little harsher environment up in the Pilbara. But with the iron ore boom, everything's become fairly luxurious up in the Pilbara, good place to operate. So we were there at the right time, managed to tie it together, and then just start drilling.
Thank you. And I noticed in one of your recent presentations, you highlighted the disconnect between the Aussie gold price and your share price. Have you got any comment for the audience about that? Get them in there somehow?
Yeah, look, we've got a slide that we like to put up, but ASX don't like it as much. And it basically just shows our enterprise value, which is pretty well flatlined for 12 months, versus the NPV of the project, which has gone up over triple in that time. And that's what we're calling the disconnect. I was chatting with a broker the other day. He feels that in the past you used to have 10 boxes to tick, and each box you got up 10 to 20% uplift depending on what it was. Whereas now people wait until some catalyst, which you're never quite sure what it is, and then suddenly you see a very quick re-rating. And if you look at that, Capricorn Metals just down the road from us, they had a massive re-rating last year. They're going to be in production next year, probably 9 months in front of us. West African, as you mentioned, have done extraordinarily well since starting development. They've gone up threefold. So it's just a matter of being patient, believing in the process, but at the same time making sure you don't dilute shareholders more than you need to along the way.
Yeah, and you seem to have a lot of targets nearby your main project. How are they being progressed?
Yeah, so we really have focused just on Klondike at the moment. We've done a little bit of soil sampling, a little bit of regional drilling, but this detailed aeromag and radiometrics really let us get our regional manager out in the field for the first time. Keeps getting drawn into the main deposit, but he will be allowed to go out there. Now, we are looking at other options in the area. We believe once we've got a mill in place, we open up within a 100-kilometre radius of us. There's a couple of big granites north and south of us that are surrounded by known gold deposits. So if we can start to access some of that and add that into the inventory, we believe this mine will be around for many decades to come.
Oh, that's fantastic. Well, look, thank you for that. Shireen, any other questions that you'd like to bring to David?
Look, none specifically for David at this point. We do have probably 5 or 6 questions to ask at the end of all of these projects. So perhaps let's move on to Mark Bennett.
Sure. Okay, Mark, thank you. If you could now start your presentation.
Mark?
Yeah, sure. Hopefully you can. Yep, can you hear me?
Yeah, you're breaking up a little bit.
Hello?
Yep, there you are.
Is anybody there? Okay, I keep on getting a message the internet is unstable, but I've been in solitary for 61 days, so it might be me that's unstable. But if I drop out, that's why. Yeah, okay, so very different from the last two presenters. S2 is a small exploration company. We were sort of born out of Sirius Resources when IGO took us over and inherited the same set of shareholders. So we're lucky for a junior that most of our shareholders get what we do, understand the risk-reward equation and the time frame. So we're aligned in that sense, which translates now to getting market support, I guess, and being able to sustain ourselves financially a bit better than most juniors to keep on doing what we do. We've been overseas largely in the recent past, in Finland and Sweden and Nevada. We had some stuff in WA, but 5 years ago when we came into being, there wasn't much available in WA, so it sort of forced us to go further afield looking for the big wins that our shareholders are invested in us for, to try and sort of replicate the Sirius story. And we're also very surgical, so we go in, we test an idea. If it doesn't turn out, we walk. And we walked from Sweden. We've recently walked from Nevada, but we're persisting with Finland, which is very promising. And we've also been trying to be a bit more Australia-centric as well. We recognise that there's foreign exchange risk. Market recognition of projects for an ASX company is better in Australia than it is overseas. And we've been starting to get a few opportunities in Australia. So we are in the process of sort of getting a bit more Australian projects in our portfolio, if you like. But we're sort of morphing at the moment, partly in response to the COVID-19 situation and partly taking advantage of it. The frustrating bit of it is we were literally one day from a drill rig arriving at our best gold prospect in Finland, where we've got up to 10 grams gold surface. And there was the threat of flights being cancelled and borders closing, and we had people from 5 different countries that we had to think about. So we had to pull the pin at the last minute and get those guys back home to their various places of origin, and we've put Finland on ice, as it were, for the time being. And hopefully, when we get to the other side of this, we can go back in and should be able to mobilise a drill rig within a week to start drilling under that 10 grams to see what's there. And in the meantime, in Australia, we've pegged a bit more ground up the west coast of WA, where we were sniffing around for nickel, platinum, palladium targets, just when Chalice announced the discovery of Julimar, up just 90 k's out of Perth. So we quickly pegged a few of those. They're in the pre-grant phase at the moment, but once they get granted, we'll be searching for similar things up near Three Springs, which is where there's a talc mine as well, and further up in the West Murchison, all along close to the Darling Fault, up the west side of the continent. So we've got that in the wings. We've also got ground in Fraser Range, which has just been granted, so it's sort of come full circle with back to where it all started with Sirius. And we won 3 out of 4 ballots for ground there. That was only granted a couple of months ago, so we're just in our preliminary reconnaissance phase there. Consequently, I guess we're at the point in, with the exception of Finland, once we can drill in our projects, where it's the pre-drilling stage and therefore not of most interest to the market. So we're lying low and using this pandemic to lie low, take 40% pay cuts, cut costs, preserve our cash, so that hopefully on the other side of this we can come out punching with a few more things under our belt and a bit more focus in Australia. And in a nutshell, that's pretty well where we're at as a company right now.
Thanks for that, Mark. And regarding Australia, do you have any particular targets? I noticed in one of your releases you talked about nickel, platinum group metals and copper. Gold as well?
With of the things we actually have in the bag at the moment, it tends to be mainly nickel, copper, PGEs in Australia, and our gold interest is in Finland. But we're working on a number of things at the moment to try and redress that imbalance, because we like to be pretty evenly balanced between precious metals and base metals, the old sort of WMC recipe, and I guess the IGO recipe, and a few others.
And how do you assess investor appetite for explorers at the moment?
I think it's pretty bimodal. You know, with everything going on in the world, as usual, the exploration sector is the first to suffer. But there seem to have been a few more discoveries or potential discoveries of late in that context, and I think as a consequence they've received extra attention. So if you've got cash and you don't need to come to market anytime soon, and particularly if you look like you're onto something promising, you're probably getting a double whammy right now.
That's very interesting. Thanks for that. Shireen, any other questions for Mark?
No, but I have one actually. Before we go to the
I don't know if anyone can.
Oh, hello. Before we go to the questions of the panel, one of the reasons we invited Mark actually to be part of this particular conversation, Mark, and no pressure, was I was told by my colleague Nick Hughes that you've had a wealth of experience across a number of years where some of these cycles, perhaps not as bad as COVID-19, but some of these drops, etc. Do you have any advice to, you know, the other mining companies on some tips on what they could do to perhaps come out of this positively? I know that you mentioned some cutting costs, etc., but any other bits and pieces of advice? No, you might have lost him.
He's gone to ground on you, Shireen.
Yeah, it sounds like it. That's okay. We might get him another time. James, would it be okay for me to, I've unmuted some of the people that have identified some questions that they would like to ask the panel. That includes Hedley Widdett, Michael Conan. We've got, I think, Lucy McLean there to ask a question, Terry Sweeney as well. So shall we go to some questions?
Sure.
Hedley, do you want to kick off?
I'd be happy to. I'm just aware that I often get a chance to ask a question. So if some of those guys who might be first timers want to go first, Shireen, I'd be pleased to sort of come on the end there. I'll leave that with you.
Yeah, why don't we go with Mr. Sweeney from TEAS?
Good afternoon, good evening, everyone. Just really want to follow on some of the comments made earlier about keeping an open mind to funding. Just really want to get a little bit of an understanding on how does the junior to mid-tier mining market perceive models from alternative service providers in the current circumstances with an ability to help mitigate some of the upfront capital by utilising their balance sheets.
So you're talking about maybe the example of a mining contractor absorbing the costs of a pre-strip or something like that up front to preserve the capital of the miner with a higher unit costs later on, that type of, is that what you're referring to?
Yeah, absolutely, Sean. Yeah, rolling it into a longer term contracting model along those lines.
Well, certainly, we certainly see our clients looking at it. You know, again, it's one of those things with, if you've got low share price, minimise the equity there and you're raising, the people are willing to sort of partner and contribute, then yeah, that's a positive. Of course, what you've got to then take into consideration, if that's going to give you a higher unit cost, there's going to be less sort of surplus revenue later on, a lower margin to then service the bank's debt. So you've got to be conscious of that. And you know, I think at the end of the day, though, as long as particularly talk more about banks, but all lenders, as long as other people have got the skin in the game early, so there's quite a lot of money in the project before the bank's money starts to go in, there's always an opportunity to look at that or discuss that. I mean, it can get, you got to be careful, I think, probably I've started now. Atlas Iron Ore. I was going to say, I don't want to know names. I mean, you look at something like Atlas, they kind of had concentric circles of debt there where everybody had contributed to the capital for higher unit costs. And so they had quite a low build there at one point at a high unit cost. And when the iron ore price fell, not only they came into trouble, but all their service providers came into trouble at the same time, because often what happens, of course, is what you've got to be concerned about and lenders are concerned about. If your civil works guy has got a very strong balance sheet and he's happy to fund your pre-strip, that's great. But if he's borrowing money from his bank to do the pre-strip for you and increasing his own debt, he's now reliant on the project as everyone else. So I think if I was looking to take support from a service provider, one of our clients was, we'd want to make sure that was kind of from a very healthy balance sheet from the service provider's perspective, not the service provider gearing to provide that service in the hope of winning that contract, if that makes sense.
Yeah, absolutely. No, thank you very much.
Michael Conan Davis, I think you've got a question for Simon in regards to bauxite.
Yes, my question really comes back to the COVID-19, and just wondering what your view on what your forward orders are looking like and how that's going to impact on your revenue.
We're lucky that we've got a long-term contract that covers about 65% of this year's production. However, I'd be lying if I said I wasn't nervous about the other 35%, because at the moment, clearly we can't travel. You know, as everyone on this call probably knows, that the Chinese business method is very relationship driven. So sitting down with them and discussing things and building friendships is part of that scenario. However, we're lucky in that we've got a couple of guys on the ground in China who are back traveling and talking to people. But I think what I'd be commenting really right now, it's just like the share market, it's very risk off. So no one's really pulling their pens out with excitement to sign contracts. They're waiting to see what happen. Our biggest customer, Junflar, has said to me that they're worried about the rest of the world because they've got no orders for aluminium, no orders for they consume about 90% of their own. But they got no orders for their finished products. So that's their concern, is that the aluminium price continues to fall. It's come off this year, although it's recovered. And so look, from our perspective right now, we're quite comfortable. We've got several months to close more orders. Clearly, it's a nervous time.
Robbie Joseph, I believe you've got a question. Hopefully we've got Mark Bennett back on the line. Robbie, do you want to ask your question?
Yeah, hi guys, can you hear me okay?
Yep.
The question, yeah, it's from Mark Bennett. You know, he mentioned before that he's had received these newly granted tenements in the Fraser Range, and we've seen Legend. Mark has helped discover Bollinger and put the Fraser Range on the map, and we've seen these recent hits from Legend Mining, and a couple of picked up some new ground there. Is there a sweeter spot or a better place to be in the Fraser Range, given his vast experience there? And where does the S2 ground sit in proximity to that? I have another question after that, and then I'll leave you guys alone.
Well, of course,
I think Mark's on the call.
the sweetest spot.
Sorry, just repeat that, Mark. We missed it.
I
think he said wherever he looks is the best spot.
That's right. No, that's, who knows? If I knew the answer to that question, I wouldn't be sitting here. I'd be out there with a spade. It's Nova. The good thing about Nova is it's all in one big blob. The new Legend discovery looks pretty promising, but it's in an area that's been mucked up a lot more. So it may not be in one blob. I think there'll be lots of areas where there'll be lots of encouraging hits, but these things are a bit like a nebula. You're not necessarily at the galactic centre. You could be on the outskirts somewhere. But there's a lot more work required to be done. There's obviously the right things happening over a huge chunk of the Earth crust in that belt. So I'm sure there'll be more, but it's going to take a lot of money to find it.
We have a question from Simon Mitchell from Southern Gold.
Yeah, good afternoon, everyone. I'm bringing the conversation back to almost the beginning, perhaps a question for James and Simon Clint. In regard to, I think one of the more interesting bits of news this week has been that streaming deal that SolGold did. The question is, do you think that BHP and Newcrest, being major shareholders, could they have done more to give SolGold more value than implied by the share price, which is the fundamental thing? So SolGold's managed to do a deal where they've got, 1/6 of their market cap for 1% of the project. So, that's a pretty good deal. But could the majors have done or been a bit more aggressive, or were they trying to be too cute and pick up more of the project on a sort of a market discounted equity basis?
Oh, Simon, thank you very much for that very political question. Much appreciated. As a completely uneducated observer, I think it would have to have been at the asset level rather than at the equity, at the headco level, right? And I think that's the advantage that people that look at the asset level can have in terms of looking through to the underlying value. Now, could each of those majors done something at the asset level? You'd have to really ask SolGold about whether they're willing to dilute directly at the asset level. I think they've done an extremely good job, as you say, with those economics by being able to do something at the asset level without diluting the headco substantially. But also, to be fair to the majors, it is Ecuador. It is on care and maintenance, for the short term. So it's not without its issues, and it is sort of it's 5 years until first production, and so it's not a project without risk either. And so I think Franco have done a particularly good job at pricing that deal where they have. So I think fair play to Franco as well.
Does anyone have any further comments around that? No.
Thanks very much.
Yeah, excellent. Thanks, Simon. We'll take one more question, and that was from Lucy from AMEC.
Thanks, Shireen. And look, really, it's a broad question back to Sean, again, probably circling back to our original discussion. What's your comments on general financing, especially for, say, junior explorers in these COVID times, and what you'd estimate as a recovery time?
Sean Russo? Oh.
Wow. Take the last part first. Who knows on the recovery time, right? No one, I don't think anyone's got a clue, right? So, I think you've got to, as I said to my kids when this first started, trust, assume you've got it, assume everyone else has got it, trust nobody, and hope for the best and plan for the worst sort of thing. So, but I think coming back to the other thing, when you say junior explorers and funding, I think the one thing that I think very clear is that I've never seen it really, or in my memory, I don't often remember it going well where someone that didn't have cash flow borrowed money. Everyone on this call will have an example where they remember it did, but the broad majority of my things, when you see people that aren't in cash flow start to borrow money because they think their share price is too cheap to raise equity, I think that's when it starts to come unstuck for people, because things do go on longer and your share price is even lower and you've got a convertible and then you're paying interest. If you're not generating income from your asset, you really shouldn't be borrowing, I think, is a rule. That was where Newcrest, I think, were trying to score some cheap points in this SolGold thing this week, talking about them taking on the debt in the short run where they've got that high interest rate of 12.5%. But that's only a bridge until the royalty comes in. I'd be appalled if SolGold had done just the part of the deal where they were borrowing money at 12.5% interest rate, but you can see the logic for what they're doing through. And I think, again, this is where, coming back to Simon and James's business model and others, if someone in a pre-production phase will give you cash that you only need to repay by producing in the future, and if you don't produce, you don't need to repay. If you think things are going to go on longer in this time frame, the royalty looks very cheap by comparison with interest associated debt, I think, and it looks cheap relative to equity on the metrics that people have been talking about.
Thanks for that, Sean. James, did you want to have a quick wrap up before we end everything?
Yeah, look, I'm hoping we got to all the questions. I'd like to thank everyone for taking part. Of course, the presenters and my fellow panelists, but for all of the audience, thank you very much. And of course, for Minds and Money for organising it. I think it's a great format. I think you've done it really well, and it's pleasingly seamless, the whole organisation. Thank you very much.
Thanks very much, James. As James said, a lot of our speakers and panelists, including our attendees, aren't used to this sort of a format, obviously a new format as we go through these particular times. Thank you very much to James and Simon from Gresham. I think I've already been asked by a number of people to start giving out some of your details because they do want to ask you some questions about your model. Sean, thank you very much for joining us. David, Simon, and obviously Mark for being part of the panel. Thank you to the panelists. As I said, we do have the APAC online event on the 23rd to the 25th of June. I'm happy to share the latest agenda on that and all the speakers that are involved. And again, obviously really excited to now also launch the IMARC Mets Arena along with the Victorian Government. So a press release and some information will be available on both of those events online as part of Minds and Money and IMARC. Thank you again, and we really look forward to the 28th of May episode where Lucy and Kate from AMEC will talk to the, their governments about what the governments are sort of doing to help mining and exploration companies during these tough times and going on to the, the next few months and years ahead. Then they'll be joined by different projects as well. So looking forward to that, as well as Whittle Consulting, and I know that we've got those guys online who are going to be sponsoring that episode. So thank you everyone for joining, and do reach out to me if you have any thing that you'd like to talk to us about. Thanks.
Thank you.
All right, thank you. Goodbye.